If you've been following the conversations, then you already know that Portugal's real estate market isn't just growing, it's evolving. We've unpacked the micro trends, we've broken down the policy shifts, but today, let's get practical. When it comes to strategy, the question I'm getting from most investors right now is this: short-term rentals or long-term lets? What's the smart move in 2025? Let's break it down in theory, but through the lens of what's actually working in the field right now. We all know the story. Municipalities like Lisbon and Porto began freezing or limiting the alojamento local, the AL licenses, back in 2023. Made the headlines. It shook confidence, and many thought it marked the decline of STRs. Now, here's the nuance. What we've seen by mid-2025 this year already isn't a collapse. It's a redistribution of opportunity. Tourism has rebounded hard, especially from the US, UK, and Brazil. And the demand? It's now flowing towards non-restricted municipalities. Think Braga, central zones in the Algarve interior, luxury short-term stays, curated high-touch guest experiences, remote-friendly units in smaller historical towns or coastal escapes. So, here's how to think about STRs today. It's not about avoiding the markets. It's about locating the market's pivot points. So you start by confirming, is the area inside the zona de contenção, a containment zone? Then layer in licensing, visibility, guest demographics, and seasonal cash flow models. But what if your investment goal is lower volatility and a bit more of predictability in a shifting landscape? Then we shift your attention to long-term rentals. LTRs are becoming the anchor strategy for many of the most stable portfolios I've reviewed this year. You've got favorable dynamics in Lisbon, outside the AL restricted zones, the growing suburbs in Porto, strategic university cities like Coimbra and Cascais. Rental yields are stabilizing between 3 to 5%, but the real edge here, it's in the policy alignments. The Portuguese government is actively rewarding long-term lease agreements, especially those over 5 years, with new tax incentives and landlord protection under the income caps. So LTR works if you are optimizing for long-term cash flow, if you want fewer moving parts, if you're holding for capital growth in key urban corridors. Still undecided? Let's compare both models side by side quickly but clearly. In plain terms, STR gives you upside if you're actively managing it and licensed to do so, while LTR gives you consistency, especially if you're operating across multiple doors or with limited time on the ground. But here's what I see the best investors doing right now. They are not picking sides, they are positioning. If you're serious about building wealth through the Portuguese property market, then diversification isn't a buzzword anymore. It's a defensive and offensive move. STR in remote or rising tourist zones, or LTR in urban tech corridors or supply constrained neighborhoods. Use each strategy where it shines the most. Let the location, local law, and your lifestyle goal guide the choice, not the market noise. Now, if you're looking to position intelligently for 2025 and you want to align your next property with both cash flow and growth, here's what to do. Click the link in the description to explore curated STR and LTR listings, or reach out directly to talk through off-market and high-yield projects we are tracking with our local and global partners. I'm Segun, and I help data-driven investors and experts uncover Portugal's emerging property opportunities before the rest of the market catches on. If this helped you out, give it a like, share it with someone thinking about Portugal, and hit subscribe. Then tap the bell so you can tap into the data, follow the drivers, find the market edge. Until I come your way next time, invest boldly, invest wisely, and invest in Portugal.